Real estate is one of the best tax strategies available, but many landlords and owners don't know how to maximize their deductions and minimize their taxes. Let's look at 4 things you need to know on how you can use cost segregation studies to boost your deductions and reduce your taxes this year. Hi, I'm David Weiner, the CEO of Cash Flow Strategies. If you're new to the channel, welcome. Please subscribe to this channel and click the bell icon for more videos designed to help you improve your cash flow, reduce your taxes, and avoid risk. And my weekly live stream, Mr. Cash Flow Live. The first tip is the cost segregation study. A cost segregation study is the practice of allocating the cost basis of property to various components of your rental real estate or commercial real estate to, instead of allocating 100% of the value to the building and land, a cost segregation study allows us to segregate or divide up the cost basis between personal property, land improvements, building, and land. That means that when we're done with a cost segregation study, we're going to have value allocated to 5-year, 7-year, 15-year, and 39-year commercial and 27.5-year property for rental residential, rather than allocating all of the value only to the full depreciable life of the building. The results of this allocation means that we will be able to depreciate certain components over a faster time period. Depreciating parts of the building faster generates large non-cash expenses and reduces taxes. The second consideration is bonus depreciation. We can use 100% bonus depreciation for any component with a useful life of less than 20 years. That cost segregation study that we went through allowed us to allocate value to the components with a useful life of 5, 7, 15, and 27.5 years, or 39 years for commercial. The nice thing about bonus depreciation is that the value that we allocated to the 5, 7, and 15-year property can be 100% expensed on the first year. Assuming that we do the cost segregation study in the first year of ownership, this bonus depreciation will result in writing off about 20 to 30% of the purchase price of your real estate in the very first year. Even if it's not done in the first year of ownership, as long as the property was purchased after September of 2017, we can go back and get the benefit for past years without amending tax returns. That can result in large passive losses that you may be able to claim on your personal tax returns. Third consideration is passive versus active losses. The third tip is that the amount of passive losses that you can take on your personal tax return depends on several things. Number 1, if you qualify as an active real estate professional. If you qualify as an active real estate professional, your losses are no longer considered passive and may be used to offset your total income. To qualify as an active real estate professional, you must 1. Provide more than 1/2 of your total personal services in real property, trades, or business in which you materially participate in the last year. 2, you must also perform more than 750 hours of services during the tax year in real property, trades, or businesses with contemporaneous time logs that detail the services rendered. And then 3rd, you must materially participate in each rental property unless you make an election to treat all interests in rental real estate as a single real estate activity. These rules are far more complicated than we can address in this video. Be very careful in determining your status as a real estate professional and consult with your tax professional or someone well-versed in the qualification process. If you don't qualify as an active real estate professional, your loss is considered passive. Under the passive activity rules, you can deduct up to $25,000 in passive losses against your ordinary income or your W-2 wages if your modified adjusted gross income, or MAGI, is $100,000 or less. This deduction phases out $1 for every $2 of MAGI above $100,000 until it hits $150,000 when it is completely phased out. If you can't utilize the passive losses due to the passive loss restrictions, you can carry the loss forward and utilize it in future years. And our fourth consideration is you don't have to wonder if this is right for you. You can find out quickly and easily if a cost segregation study would benefit you and your property specifically. To get a free preliminary analysis of your property or properties, it'll only take a couple of minutes and may save you huge amounts on your taxes. Send me this information and I'll get that free analysis for you. It'll show you what an engineering-based best method cost segregation study done by the premier cost segregation provider in the United States would cost and the estimated tax benefits that you would realize. I'll be happy to review the analysis with you if you like, as well as answer any of your questions about the real estate professional designation and your situation and how cost segregation may work for you. Thanks for watching this video. I'm excited to help you lower your taxes with these tremendous strategies. If this video has been helpful to you, please hit the like button and share it with others that you know who may be able to benefit from it. Once again, I'm David Weiner from Cash Flow Strategies. After all, it's your money. Keep more of it.